Today's market looks exactly like 2005 to 2007. People are leveraging to the hilt and doing quote-unquote dumb things.
Why?
Yeah, that is not a paraphrase. That is a direct verbatim quote from Monday. And when you drop those specific years, I mean, 2005, 2006, 2007, you know exactly what you're doing.
Oh, absolutely. You are explicitly invoking the ghost of the great financial crisis.
Mm-hmm.
The housing bubble, Bear Stearns, Lehman Brothers. It is a highly specific, highly loaded time frame to reference. It's the Wall Street equivalent of, shouting fire in a crowded theater.
Exactly. And that reference didn't come from some anonymous, perma bear on Twitter with a laser eye profile picture or some newsletter writer trying to sell you gold bars.
Right.
That was Jamie Dimon, the CEO of JPMorgan Chase, arguably the most important commercial banker on the planet, speaking yesterday at their Investor Day in New York. He is flat out warning that the rising tide is hiding some very ugly rocks, specifically in private credit, and he basically thinks the sky is falling.
And yet, if you looked at your trading screen today, Tuesday, February 24th, 2026, you would honestly think Jamie Dimon was broadcasting from a completely alternate dimension.
Yeah.
Because the NASDAQ composite did not care about his rocks.
Not at all.
It ripped 1% higher today. The S&P 500 is up nearly 0.8%. We are just seeing this massive sea of green. It wasn't a crash. It was a massive buying party.
And that right there is the conflict we are sitting with. That's the central tension of today's deep dive. Who is actually right here? Is it the CEO of the world's largest bank telling us we are in this pre-crash bubble fueled by shadow debt? Or is it the traders who just aggressively bid up basically every software stock in existence this afternoon?
It's a trillion-dollar question.
Welcome to the deep dive. It is Tuesday afternoon. The closing bell has officially rung, and we have a monumental amount of data to unpack for you today.
We really do. It is an incredibly fascinating setup. But before we break down the charts, the macro landscape, and the absolute madness we saw in the price action today, we have to quickly pivot to our standard Theta Fuse disclaimer.
Right. For the new folks joining us, or maybe those of you who just stumbled in from the algorithm, we look at this market chaos through a very specific lens. This channel is entirely about option strategies.
Correct. We aren't just looking at, directional price movements. We are looking at volatility. We are talking about cash-secured puts, EPS, and selling premium. We are looking for theta, that beautiful time decay to harvest. However, and this is the crucial part, we are educational only.
Very crucial.
We are not your financial advisors. We are just two people analyzing the data and discussing the mechanics of these strategies. You have to trade your own plan, you have to manage your own risk, and frankly, never, ever sell a put you aren't perfectly willing to get assigned on.
Ideally at a steep discount.
Ideally at a massive discount when there is literal blood in the streets.
Right. Okay, the legal disclaimer is out of the way. Let's set the scene for you. It is Tuesday, February 24th. We are sitting here looking at a market that is aggressively climbing what the old-timers call the wall of worry. We have this Anthropic bailout, which we're officially calling the software relief rally.
A massive rally.
Huge. Then we have a hardware supercycle story with AMD and Meta that literally just broke today. We have Jamie Dimon and Donald Trump providing these intense macro headwinds. And, of course, we are less than 24 hours away from the Super Bowl of the stock market.
Nvidia earnings
tomorrow. Everything else is just the pregame show. But let's actually start with what happened today, because yesterday, Monday, felt like the literal end of the world for software stocks. We were calling it Software-mageddon.
It really was brutal. To understand the relief rally we saw today, you really have to understand the pure fear that was gripping the market yesterday. It wasn't just, general bad macro vibes. It all circles back to this specific research paper from Citrini Research that started circulating over the weekend and really took hold of the narrative on Monday.
Yeah, it painted a very bleak, almost dystopian picture for the software as a service model, the SaaS model.
Extremely bleak.
I read through that entire paper, and the headline number that terrified everyone was a prediction of 10.2% unemployment by the year 2028.
Right. And we just need to pause on that number for a second.
Right.
10.2%, that is deep recession level stuff. That is bordering on depression level economics for the modern era. But the driver of that unemployment, according to the Citrini paper, isn't a traditional cyclical credit downturn. It isn't high interest rates crushing the housing market. It is AI displacement.
This is the agentic AI thesis.
Exactly. The core thesis is that AI rapidly displaces human software jobs, human delivery jobs, and human coding jobs. But here's why that specifically murders software stocks. The entire SaaS business model is built on the seat license. You charge, say, $100 a month for every single human using your software platform.
Right, per user per month.
Exactly. So if a company fires 500 human employees because one AI agent can do all their jobs, they don't need those 500 Salesforce licenses anymore. They might need one or maybe five.
So the Wall Street math becomes very simple. AI capabilities go up, corporate headcount goes down, and SaaS revenue essentially goes to zero.
That was the existential fear that flushed the entire sector on Monday. We saw legacy names down double digits month to date. And then, just to add gasoline to the fire, Goldman Sachs put out a note from their economist, Pierfrancesco May.
I saw that note. It wasn't as apocalyptic as the 10% figure, but it definitely wasn't bullish.
No, it wasn't good at all. Goldman is officially projecting that AI-driven labor displacement could raise the baseline unemployment rate to 4.5% by the end of 2026, up from the current 4.3%. Now, you hear 4.5% and it doesn't sound like a disaster historically.
No, it sounds pretty normal.
Right. But you have to look at the macro context. We are currently in a period of skyrocketing corporate productivity. Usually, historically speaking, when companies are this productive and this profitable, they expand. They hire more people. Goldman is saying, no, productivity goes up, but employment goes down.
Which is a complete paradigm shift.
It's a signal of structural, permanent labor displacement. It validated the fear that AI is coming for the white-collar jobs market and, by extension, the software seat license model.
So Monday, everyone panic dumps software. The narrative is SaaS is dead. Then Tuesday morning comes around today, and suddenly the entire narrative flips on a dime. Enter Anthropic.
The Anthropic pivot. This is honestly a textbook example of how a market narrative can shift from replacement to enhancement in a single press cycle. Anthropic held this big virtual event this morning to update the market on their Claude chatbot and their enterprise AI tools. And instead of coming out and saying, hey, we are going to destroy Salesforce, they said, we are partnering with Salesforce.
And the market absolutely loved it. It was like the entire tech trading floor let out this massive breath they had been holding for 48 hours.
It was a classic violent relief rally. The Citrini paper had everyone thinking these legacy, highly valued software companies were basically going to zero. And then Anthropic comes out and announces a whole suite of these plugins. They're integrating Claude directly into the daily workflows of some of those entrenched incumbents in the space.
Let's actually run through the specific tickers because the intraday moves were significant, and I really want to understand the why behind each one for you guys. Let's start with Salesforce, ticker CRM. They were taking an absolute beating recently. Today, up roughly 4 to 5%.
Right. So the integration there is via Slack, which Salesforce owns, and their core CRM workflows. The fear on Monday was that an AI agent replaces the human salesperson entirely. The Anthropic pitch today is, no, the AI agent lives inside Slack. It acts as a co-pilot. It helps the human salesperson draft the email, update the client record, pull the data, and close the deal faster. It makes the human 10 times more efficient.
Which critically preserves the seat license.
Exactly the point.
Yeah.
If the human is still sitting in the chair, just super powered by Claude, the enterprise keeps paying Salesforce that monthly fee. The market looked at that pitch today and collectively said, okay, the revenue cliff isn't happening tomorrow morning.
Then you had FactSet, ticker FDS. This one really jumped, up nearly 6% on the day. That is the best single trading day FactSet has had since, I think, mid-2022.
And this makes perfect logical sense if you think about what FactSet actually does. It's investment banking, it's portfolio analysis, it's deep data scrubbing. Frankly, it is incredibly tedious work. Anthropic's new plugins are specifically designed to automate deal review and large-scale portfolio analysis. The grunt work. The exact grunt work that first-year analysts do. If you can plug Claude directly into FactSet, you make the banker vastly more efficient.
Yeah.
Now, you could certainly argue that eventually, 5 years down the line, you need fewer junior bankers. But for now, today, the market sees this as a massive value add to the FactSet subscription rather than a replacement of it. It justifies their pricing power.
It makes sense. Then we have DocuSign, ticker DOCU. They were up about 3 to 5% as well today.
Same exact story. Think about HR tasks, bringing complex legal documents into compliance, matching a company's specific brand tone across contracts. It's an efficiency play. It anchors the corporate user even deeper into the DocuSign platform.
And even IBM, I mean, this one blew my mind. IBM got absolutely crushed on Monday. It was their worst day since the dot-com bubble, or at least something close to it, specifically because Anthropic had previously said Claude Code could modernize IBM's legacy programming languages.
Yes, the COBOL threat.
Right. Everyone read that as IBM's incredibly lucrative consulting business is dead overnight because an AI agent will just fix all the ancient bank COBOL code for free.
Which, to be fair, is a very valid long-term structural fear. IBM makes an absolute fortune maintaining ancient banking and government systems. If an AI can rewrite that code flawlessly for a fraction of the cost, IBM loses billions in billable hours. But today, IBM recovered about 3.5%.
Why the bounce, though?
Because the market realized, wait a minute, someone still has to actually run and oversee the AI that fixes the code. Banks aren't just going to let an open-source bot rip through their core ledgers unsupervised. They will hire IBM consultants to manage the AI integration. It was a massive overreaction yesterday, followed by a logical relief bounce today. We also saw Intuit, ticker INTU, up 2.8%, and Intap, ticker INTA, surging 7.1%.
So here is the real question for you, for our Theta traders and premium sellers out there. We look at this specific price action and we see implied volatility, IV, just spiking to the moon on the pure fear yesterday and then aggressively crushing today on the rally. What is the actual actionable takeaway here? Is the software is dead trade completely over? Is the ultimate bottom in? Or is this just a classic dead cat bounce?
That is the most dangerous question in the market right now. Look, from a pure volatility perspective, the software is dead trade became incredibly crowded on Monday. When a trade gets that one-sided and literally everyone is buying downside puts, IV goes through the absolute roof. Options get incredibly expensive.
The premium gets juiced.
Heavily juiced.
Yeah.
That created the absolute perfect technical storm for a relief rally. All you needed was one single piece of quote-unquote not terrible news, which was the Anthropic partnership announcement, to trigger a massive short squeeze and an IV crush.
So you really think this is mostly technical?
A huge part of today's move is technical. Just look at the month-to-date numbers, even with this beautiful sea of green on the screens today. Many of these legacy SaaS names are still down double digits for the month of February. Workday has been struggling. Adobe has been demonstrably weak. This is a bounce. It relieves the immediate oversold technical condition. But does it solve the long-term existential threat that the Citrini paper highlighted?
Probably not.
No. It just pushes the timeline out a few years.
So the overarching thesis of AI eats software isn't necessarily wrong, it's just early.
Precisely. And in the financial markets, being early is exactly the same thing as being wrong. If you are a Theta trader, Monday was a phenomenal opportunity to sell cash-secured puts when the fear was at its absolute peak and premiums were historically fat. Today, those short puts would be up 50 to 60% just on the IV crush and the underlying delta move.
You could just buy them back to close and take the profit.
Exactly. But would I aggressively go long these specific legacy software stocks for a 10-year hold right now at these valuations? I'd be very, very careful. The integration with Anthropic is a temporary Band-Aid. It is not a permanent cure for the seat license problem.
It's buying the dip when the panic is highest. It works until it doesn't, but yesterday it definitely worked. But look, it wasn't just software today. We have to talk about the hardware side of the equation because the pick and shovel trade is clearly still very much alive and kicking.
It is more than alive. It is actually accelerating. And the sheer scale of what was announced today is frankly mind-boggling for anyone who follows infrastructure.
We're talking about AMD, Advanced Micro Devices, ticker AMD. The stock surged nearly 9% today. It closed up at $213.84. This was a massive, violent move for a company of that market cap. And it is all because of Mark Zuckerberg.
It is the Meta connection. And this is an incredibly fascinating deal structure. So the headline news is that Meta Platforms has officially entered into a multi-year agreement to use AMD's Instinct GPUs. We are talking about up to 6 gigawatts of compute power.
6 gigawatts. Let's just pause on that unit of measurement for a second. We usually talk about AI compute in terms of units, like, oh, they bought 100,000 H100s, or we talk in petaflops. Talking about it in terms of pure power consumption, gigawatts, really highlights the physical scale of this infrastructure build-out.
Yeah.
I mean, 1.21 gigawatts was enough to send Marty McFly back to the future. Meta is buying 6 gigawatts worth of chips from AMD.
It is physically massive. A single gigawatt is roughly the power consumption of a mid-sized American city. We are talking about building multiple nuclear power plants worth of dedicated compute. And what this does is it completely confirms that the AI CapEx cycle, the capital expenditure cycle, is nowhere near finished.
Right, because there was a lot of chatter about a slowdown.
Exactly. People were genuinely worried a month ago that Meta and Microsoft and Google were going to suddenly pull back on their spending because the ROI wasn't there yet. This deal says the exact opposite. They are locking in massive physical supply for years into the future.
But the truly interesting part, and I want you to really unpack this for you guys listening, because this is where the advanced strategy comes in, is the actual way the deal was paid for. It wasn't just a straight cash transaction. There is a very specific warrant structure involved.
Correct. This is where it gets really fun for financial engineering nerds like us. AMD issued Meta a warrant to purchase up to 160 million shares of AMD common stock. But, and this is the key distinction, it is a performance-based warrant. It vests based on actual shipment milestones.
Break that down in plain English. What does vesting based on shipment milestones actually mean for the mechanics of the deal?
It means Meta only gets the legal right to buy that stock at a set price if AMD actually delivers the physical goods. The first tranche of that massive warrant vests when AMD successfully ships the first 1 gigawatt of computing technology to Meta's data centers. This aligns the corporate incentives perfectly.
How so?
Well, Meta desperately wants the chips to work, and they want them delivered as fast as humanly possible because the second they take delivery, they get a massive chunk of equity in AMD.
And if AMD stock goes up, which it highly likely will if they are successfully selling 6 gigawatts of premium chips, Meta essentially participates in that financial upside.
Exactly. It effectively lowers Meta's overall cost of goods sold over time. Think about it. If AMD stock rips to $300 a share, and Meta holds a vested warrant to buy 160 million shares at a much lower strike price, they make billions of dollars on the stock trade alone.
Which basically pays for the chips.
It completely offsets the massive capital cost of the hardware. It's essentially a corporate rebate on steroids.
It's honestly a brilliant lock-in strategy by AMD. Because let's be totally honest here, Nvidia is the 800-pound gorilla in the room. Everyone defaults to CUD. Everyone defaults to Nvidia H100s and the new Blackwell chips. AMD has perpetually been the underdog fighting for scraps. By giving Meta this equity upside, they are basically bribing, or let's say financially incentivizing, one of the biggest single buyers in the world to stick with the AMD ecosystem.
It creates a concrete fundamental floor for the entire semiconductor sector. It physically tells the market that end-user demand is real and it is fully funded. And notice the distinct price action disparity today. AMD ripped 9% higher. What did Meta do?
Flat. Basically completely unchanged, down maybe 0.02%.
Right, because for Meta, this is still a massive capital expense. It's absolutely necessary CapEx to stay in the AI race, but it's still tens of billions of dollars going out the door. For AMD, this is pure revenue validation. The immediate market value accrues to the chip supplier here, not the buyer.
And strategy-wise, as we head into NVIDIA earnings tomorrow, this AMD news is absolutely crucial. It sets an incredibly positive tone for the whole sector. If AMD is selling every single chip they can physically manufacture, NVIDIA probably is too.
It removes the immediate demand cliff fear. There was this lingering worry that maybe hyperscaler demand was quietly softening. This 6 gigawatt deal violently kills that narrative for at least another quarter.
Okay, so we have software aggressively bouncing on an Anthropic efficiency narrative. We have hardware absolutely ripping on a massive, undeniable CapEx narrative. But then we have the ominous macro clouds on the horizon. We really have to talk about the wall of worry. And we have to circle back to Jamie Dimon.
The boss. You always have to listen to the boss.
He did not mince words at the Investor Day. Let me read it again. Today's market looks exactly like 2005, 2006, and 2007. That is such a hauntingly specific time frame to reference. Why those exact 3 years?
Because he is directly referencing the pre-crisis leverage buildup. If you remember 2006, the housing market was actually starting to internally crack, the subprime defaults were ticking up, but the mainstream stock market was still hitting all-time highs. There was this pervasive feeling of total invincibility.
The Goldilocks economy.
Yeah, right. Dimon said, the rising tide lifting all boats, everyone was making a lot of money, the sky was the limit. He's looking at today's market, and he's worried that people are getting dangerously comfortable again. He explicitly told the crowd, my own view is people are getting a little comfortable, that this is real.
And he specifically called out people doing dumb things. He said, I see a couple of people doing some dumb things. And he specifically pointed his finger toward private credit.
This is the absolute crux of his argument. Private credit is the new shadow banking system.
Let's define that for the listeners. What exactly is private credit, and why is it scaring the most powerful banker in the world?
So after the 2008 crash, the federal regulators heavily clamped down on big traditional banks like JPMorgan. They made it much, much harder and more capital intensive for them to lend money to highly risky, highly leveraged companies. So who stepped into that void?
Private equity.
Private equity firms and dedicated private credit funds. They raise hundreds of billions directly from institutional investors, pensions, endowments, and they lend it directly to these risky companies. It's a multi-trillion-dollar market now operating largely outside the traditional banking system.
Okay, so these companies get their loans from Wall Street instead of a traditional bank. What is the actual systemic problem?
The core problem is transparency, or rather the total lack of it. Public stocks are priced every single second of the trading day. Traditional bank loans are heavily regulated and stress-tested. Private credit is completely opaque. It's not marked to market every day.
Meaning they don't have to admit if a loan is going bad.
Exactly. A private credit fund might tell their investors, oh yeah, that loan to that struggling SaaS company is definitely still worth 100 cents on the dollar, even if the underlying company is secretly bleeding cash because nobody is legally forcing the fund to reprice the debt until there's an actual default. Dimon is warning that there are massive risks hidden in there, bad loans that we simply won't see until the macro liquidity suddenly dries up.
He used the cockroach analogy again, didn't he?
He loves that analogy. When you see one cockroach, there's probably more. He said that back in October regarding some early bad loans. Now he is applying it to the broader leverage in the entire financial system. He's essentially saying that when interest rates are held this high for this long and underlying economic growth starts to slow down, those hitter bad loans in the opaque private credit market are going to start blowing up one by one.
But here's the thing that strikes me as deeply ironic about all this. JPMorgan's stock itself was down slightly today, maybe 0.1%, but they're also simultaneously spending an absolute fortune to stay in the tech game. They announced at that same investor day that they are allocating $19.8 billion to technology this year alone. So even while Dimon is warning everyone about a massive systemic bubble, he is forced to aggressively participate in the AI arms race.
He has literally no choice. If he doesn't spend that $20 billion on tech infrastructure, some nimble fintech startup or some AI-native bank is going to eat his lunch in 5 years. But there's another significant layer to the JP Morgan story that we definitely have to mention, because it directly adds to the broader headline risk, the Epstein files.
Yeah, this broke from a Bloomberg source today. It's really not a great look for the bank.
It's a massive reputational headache. The new report shows that multiple high-level JP Morgan executives stayed in direct touch with Jeffrey Epstein well after the bank officially publicly kicked him out as a client in 2013. He was apparently still wiring money. He was looping in other massive clients like Leon Black. It clearly shows a proximity to power that investors do not like seeing in the headlines.
Especially since they already settled for $365 million in 2023 over this exact issue.
Right. And financially speaking, the bank can easily handle it. A $365 million settlement is a literal rounding error on JPM's balance sheet. But reputationally, it just adds bricks to that wall of worry. It's another reason for institutional investors to be skittish. Yeah. If the legendary CEO says a market crash is coming and the front page headlines say scandal, it creates a very real psychological weight on the stock.
And speaking of psychological weight, we have the State of the Union address tonight. President Trump is going to be speaking to a Congress that is, frankly, pretty universally hostile to his trade policies right now.
This is the ultimate macro wild card for the week. We have a global trade war brewing that is actually officially live right now. As of today, Tuesday, that 10% global import tax went into full effect.
Right. It is officially live. This isn't a campaign threat anymore. It's legally happening at the ports today.
It is live. But the crucial thing to understand is the market has mostly priced in that 10% baseline. The real threat, the massive volatility catalyst hanging over the market, is the 15% tariff threat. Trump is heavily threatening to hike it to 15%, specifically because the Supreme Court recently ruled against his reciprocal tariffs program. He is angry about the ruling. He's going to Capitol Hill tonight to aggressively defend this policy. And the recent poll shows 64% of Americans disapprove of how he is handling the tariff situation.
Usually, political gridlock is actually seen as good for markets. Wall Street loves it when Washington can't pass new laws, but trade war chaos by executive order is not good, and we definitely saw gold react to this uncertainty today.
Gold is the ultimate fear gauge here. It pulled back a bit today, trading right around the $5,000 an ounce mark.
Wait, $5,000? I thought we were quite a bit higher than that recently.
We definitely were. We hit an all-time high of $5,595 back in late January, so we are currently down about 10% from the absolute peak. We are consolidating, as the technical analysts like to say. Asian traders are fully returning from the Lunar New Year holidays, and they are naturally taking some profits off the table. But the very fact that gold is holding that $5,000 psychological level tells you there's massive underlying institutional demand for a hard hedge against the Fed and against this specific trade policy chaos.
What about Bitcoin? Usually the crypto community tells us Bitcoin is digital gold, the ultimate safe haven. Is it actually acting like gold right now?
Not even a little bit. And this is a hugely crucial distinction for anyone trading these assets. Bitcoin is currently acting exactly like a high beta risk asset, a tech stock on leverage. It is trading around $64,000 today. It is officially heading for its worst single month since June of 2022. It's down roughly 19% just in February.
Wow, that completely blows a hole in the whole safe haven narrative.
It shatters it. The narrative that Bitcoin is a safe haven against tariffs or inflation simply isn't holding up in the actual price action. The traditional market sees broad tariffs as fundamentally bad for global liquidity and bad for corporate risk-taking. And Bitcoin is currently the ultimate global risk asset. So when Trump talks aggressive tariffs, global liquidity subtly tightens and Bitcoin violently sells off. It is behaving exactly like an unprofitable tech stock, not like a physical store of value right now.
Okay, so that is the incredibly complex landscape we are dealing with. We have software violently bouncing, hardware booming on CapEx, macro threatening to ruin the party, and commodities correcting. This perfectly brings us to the strategy session. The real reason you are all tuning in tomorrow. Wednesday, the absolute main event.
Nvidia earnings.
It really is the Super Bowl of the modern stock market. I feel like we say this every single quarter, but the fundamental stakes just keep getting astronomically higher. Nvidia closed today up about 0.68%. The entire global market is basically holding its breath right now.
It is arguably the single most important chart in the world. If Nvidia slightly misses, or frankly, even if they just meet current expectations without massively raising forward guidance, the entire AI trade, that AMD rally we saw today, the software relief rally, it could all aggressively unwind in minutes.
So talk to me about the Theta fuse play here. We are options traders. We don't just blindly buy calls and hope for a miracle. What is the optimal setup for tomorrow?
The setup is entirely about implied volatility. 4. Because you have the State of the Union address tonight combined with the earnings print tomorrow afternoon, the premiums on Nvidia options are historically juiced. They are incredibly expensive. The market makers who price these options are terrified of being on the wrong side of a 10% structural gap or down, so they completely jack up the price of the insurance they sell.
Explain juiced premiums for the beginner who might just be starting out with options.
Absolutely. It simply means the current price of the option contract is trading way, way above its normal statistical value. If an out-of-the-money call option usually costs, say, $5 on a normal Tuesday, today that exact same contract might cost $10 or $12, simply because the anticipated uncertainty of the earnings event is so incredibly high.
Which means buying those options outright is mathematically incredibly risky. If the stock moves in your direction, but it doesn't move enough to overcome that inflated premium, you get absolutely crushed by the volatility collapse.
Exactly. This is the infamous IV crush. It destroys retail traders every quarter. Let's actually do the math on it. Let's say Nvidia is currently trading at $130. You buy a $140 strike call option for $5 because you think Jensen Huang is going to announce a massive beat and the stock is going to rip. Tomorrow, the earnings come out. They're great. Nvidia goes up to $138. Great news, right? The underlying stock is up. But the event is past. The massive uncertainty is gone. The implied volatility drops from 100% down to 40% instantly. That $5 option you bought might open the next morning at $3, even though the stock went up $5. You lost real money because the mathematical error came out of the premium balloon.
So the core philosophy here is we don't buy the balloon. We want to be the ones selling the balloon while it's completely full of air.
Exactly right. We want to be short Vegas. We want to be short volatility. The optimal Theta fuse strategy in this specific high-stress environment is to be a net seller of premium, specifically selling cash-secured puts.
Walk us through the exact logic of that trade. Why selling puts instead of calls?
Think about the broader market psychology we just discussed. You have Jamie Dimon explicitly scaring people about 2007. You have Trump scaring people about global trade wars. You have intense baseline anxiety about these massive tech valuations heading into earnings. Because of all that, people are heavily overpaying for downside protection. They are aggressively buying puts to hedge their portfolios. As a contrarian options trader, you want to step in and sell them that fear.
So you find a specific strike price that you're actually comfortable owning Nvidia stock at. Let's say a level significantly lower than where it is trading today.
Right. You look at the chart for a strong level of technical support. Maybe you look at the 50-day moving average or a previous consolidation zone. Let's just say, hypothetically, you look at the $110 level. You sell a put contract at that $110 strike. You instantly collect that fat-juiced premium upfront in your account. That is your cash to keep.
And from there are basically two potential outcomes once the earnings drop.
Correct. Outcome A, which is the most common, Nvidia rips higher, or it simply trades sideways. The underlying fear evaporates. The IV aggressively crushes. The $110 put you sold rapidly loses value and eventually expires worthless, which is exactly what you want as the seller. You keep 100% of the premium. You made money purely on the Theta decay and the Vega collapse. You literally got paid to do nothing.
An outcome B.
Yeah.
The disaster scenario where everything goes wrong.
Outcome B is Jensen Huang comes out on the call and says, hey guys, AI demand is actually slowing down. The stock violently crashes. It blows right through your $110 strike price. You get assigned the shares. You were legally forced to buy 100 shares of Nvidia at $110. But this is the critical part, because you collected that massive premium up front, your true cost basis is actually much lower than $110. Maybe it's $105. You're acquiring a blue-chip tech asset, the absolute leader of the AI revolution, at a steep discount during a market panic.
That is the ultimate Theta Fuse way. You are effectively getting paid a massive yield to set a limit order to buy a stock you fundamentally want to own anyway.
Exactly. And when you factor in the AMD news we got today confirming that the massive CapEx cycle is continuing, the historic 6-gigawatt deal with Meta, the fundamental floor for Nvidia is incredibly solid right now. The physical end user demand is clearly there, so selling into the immediate short-term fear feels like a very high probability trade setup.
I absolutely love it. Selling fear to the fearful. It's the only way to trade these events. Before we completely wrap up with our big question for the audience, let's do a quick lightning round. There were a few other specific tickers moving today that definitely caught our eye, and I want to get your quick fundamental take on the why behind the moves.
Let's hit them.
First up, Workday, ticker WDAY. We talked extensively about the software relief rally today, but Workday seems to have completely missed the memo in the after-hours session.
Yeah, they were heavily set up to report earnings tonight. Going into the close, they were actually up 0.79%, basically just riding that broader Salesforce and Anthropic wave of optimism. But after hours, once the numbers dropped, they're currently down about 7%.
Oof. Down 7% is tough. Why the massive divergence? Did they miss the top and bottom line?
It wasn't the past quarter. It's all about the forward guidance. Wall Street analysts had been aggressively slashing price targets on Workday all week leading up to this. Jefferies literally cut their target from $325 all the way down to $150. The core fear here is that AI is fundamentally going to compress their margins over time. Unlike Salesforce today, Workday simply hasn't convinced the broader market yet that they have an Anthropic-style savior waiting in the wings. They are generally viewed as a system of record. They are essentially just a massive, complex database of corporate employees. And basic databases are exactly what gets rapidly commoditized by AI agents.
Wow, so the market is aggressively separating the AI winners from the legacy losers right now. Next up, Tesla, ticker TSLA, up 2.4% today. This one genuinely confuses me because the actual fundamental news flow today was actually pretty terrible.
This is a classic quintessential Tesla resilience story. The actual headlines were undeniably bad. Official EV sales in Europe dropped 17%. BYD is aggressively eating their market share over there. There is a brand new lawsuit over their hiring practices. And on the tech side, Waymo Alphabet's autonomous robo-taxi division just officially announced they are rapidly expanding their commercial operations to Dallas, Houston, and San Antonio. Waymo is executing on real revenue-generating robo-taxis right now, while Tesla is still essentially promising them for the future.
And yet, despite all of that, the stock goes up 2.4%.
The stock goes up because Tesla consistently trades on retail vibes and future tech promises, not just on current quarterly car deliveries. The market is completely ignoring the weak European sales data for now, probably just blindly betting that the broader AI hardware supercycle lifts all associated tech boats, including Tesla's FSD narrative.
Incredible. Okay, Lucid, ticker LCID, the other high-profile EV play in the market.
They reported Q4 numbers. Top-line revenue was up an impressive 96% year-over-year to $459 million. That headline number sounds absolutely fantastic, but you have to dig deeper. It's almost entirely due to the initial ramp-up of their new Gravity SUV model. The perpetual issue with Lucid is always the massive cash burn. They're fundamentally bleeding money on every single car they build to reach scale. But the stock was actually moving a bit positive on the sheer revenue beat. It's strictly a survival play at this point. If they can somehow survive the cash crunch long enough to reach mass manufacturing scale, they might actually make it.
And finally, a great proxy for the real physical economy, Home Depot, ticker HD.
Up a solid 2% today. They actually beat earnings expectations. But the commentary from the CEO and the CFO on the conference call was the real macro story here. They explicitly stated that overall housing turnover has been entirely frozen for 3 years.
Frozen. That is a very strong, very deliberate word for a CEO to use.
It means nobody is physically moving. Nobody is voluntarily selling their house because they are financially locked in to those 3% pandemic-era mortgage rates. And if nobody moves, nobody does major renovations. The fact that Home Depot actually managed to beat earnings in a completely frozen macro housing market is honestly incredibly impressive. It strongly suggests that if the Fed ever does significantly cut rates down the line and that housing freeze finally thaws out, Home Depot could absolutely rip higher. It's essentially a tightly coiled fundamental spring.
All right, that brings us to the end of the data stream for today. It has been an absolutely wild 24 hours in the market. We went from pure software doom yesterday to a massive software boom today. We have 6 gigawatts of premium AI chips going straight to Meta's data centers, and we have the President of the United States and the biggest commercial banker in the world aggressively fighting over the macro narrative.
It truly is a trader's paradise right now. Extreme volatility is extreme opportunity if you know how to structure your trades.
So here is the final question we want to leave you with today, and this is specifically for the comment section below. We want a strict binary answer, a simple yes or no.
We talked extensively about Jamie Dimon at the top of the show. He explicitly says, we are basically living in 2007 again. He says people are actively doing dumb things and leveraging to the hilt in private credit.
So the fundamental question for you is Jamie Dimon right? Are we currently sitting in a 2007-style macro bubble that is inevitably about to pop?
Or, on the flip side, is he just an old guard traditional banker who fundamentally doesn't understand the scale of the current AI productivity boom?
Yes or no? Drop your answer in the comments right now. We will actively read the best and most contrarian arguments tomorrow afternoon, right after we see what Nvidia earnings actually do to the market.
Stay disciplined out there, keep selling that Theta, and relentlessly manage your risk.
And we will see you all tomorrow for the Nvidia aftermath. Class dismissed.
See you then.